Most startups that get funded are not the best ideas. They are the best stories told to the right people at exactly the right moment. That is the first thing nobody tells you about venture capital. In 2004, a 20-year-old college dropout walked into a meeting with a group of investors in Silicon Valley. He had no revenue, no product, just a website with a few thousand users and a hoodie he never seemed to take off. He asked for $500,000. He walked out with that and more. The investors were not betting on the website, they were betting on him. And that distinction, that gap between what looks fundable and what actually gets funded, is where the entire game is played. To understand how venture capital really works, it helps to understand what a venture capital firm actually is. It is not a charity, it is not a bank, it is a machine built to take enormous risk on purpose. A firm raises money from university endowments, pension funds, family offices, and wealthy individuals. Those investors hand over their capital expecting it to be multiplied. The VC firm then has roughly 10 years to invest that money, grow it, and return it, with a significant profit on top. So when a venture capitalist sits across from a founder, the question running through their mind is not simply whether this business is good. The question is whether this business can return the entire fund. One investment, 10 times the money, sometimes more. That changes everything about how decisions get made. A fund might invest in 30 companies over 5 years. Statistically, 15 of those will fail completely. 10 will survive but go nowhere interesting. 4 will do reasonably well, and 1, if the partners are skilled and lucky in equal measure, will become something enormous. That one company has to pay for all the others. This is not pessimism, it is the math that drives every single decision a VC firm makes. When they pass on a startup, they are not saying the business is bad, they are saying the business cannot be that one company. That distinction matters. So the question becomes, how do they decide which company has a chance at being that one? The first thing they look at is the market, not whether the market exists today, but whether it will be large enough tomorrow to make the investment worthwhile. A startup solving a problem for 5 million people sounds meaningful, but if each of those 5 million people will only ever pay $10, the ceiling is visible from the beginning, and visible ceilings make investors nervous. They want markets that are still forming, markets where the size itself is still a matter of debate, because if everyone already agrees the market is big, the competition is already there too. In the late 1990s, investors poured money into online pet food delivery. The market was real. People have pets. People buy pet food. The logic seemed sound. But the cost to acquire a customer, pack the food, ship it across the country, and handle returns was more than the customer ever spent. The market existed. The business did not work. Investors learned to separate the two. A big market and a viable business are not the same thing, and a room full of smart people with spreadsheets can still get that wrong. After market size, they look at the team, and this is where things get genuinely strange, because the weight placed on a founding team is almost impossible to explain rationally. Investors will fund an average idea with an exceptional team before they fund an exceptional idea with an average team. This happens constantly. It seems backwards until you understand the reason. A great team can change the idea. A bad team cannot be changed by a great idea.
What they are really evaluating when they assess a team is something harder to quantify than credentials. They are asking whether this person has ever done something genuinely difficult before, and whether they pushed through it or stopped. They're looking for what one early Sequoia partner used to call the courage to be wrong in public. It sounds like something printed on an office wall, but what it actually means is this. Can this founder absorb being rejected, being mocked, being told they're wasting their time, and then show up the next morning and keep building? Because that is what building a company is. Not the pitch deck, not the launch day, the years of quiet, grinding difficulty in between. There's a pattern that shows up repeatedly in the histories of funded startups. The founders who get backed are often the ones who already tried something and failed. Not because failure is romantic, but because failure is information. A founder who was burned through a previous company, felt what it costs, learned what they did not know, and decided to go again is a different kind of risk than a first-time founder stepping off a comfortable salary for the first time. The second person knows what is coming. That knowledge is worth something. Once a firm is interested in a team and a market, the real work begins. It's called due diligence, but that phrase sanitizes what it actually involves. Investors call former employees, customers, rivals, and ex-partners. They ask uncomfortable questions. They look for inconsistencies between what the founder says in the pitch and what people who worked with them say in private. They are not doing this to be adversarial. They are doing it because by the time a deal closes, they will be tied to this person for 7 to 10 years, longer than most marriages. And unlike a marriage, it is very difficult to leave early. The product matters, but not always in the way founders expect. Investors do not need a perfect product. They need evidence that people want the product. There is a phrase that circulates in venture circles, and it is deceptively simple. It's called product-market fit. What it means, stripped of the jargon, is that somewhere out there, real people are using this thing, and they would be genuinely upset if it disappeared tomorrow. Not mildly inconvenienced, upset. That emotional response, that dependency, is the signal investors spend years learning to detect. The most dangerous version of a startup is one that people use but would not miss. Free products attract enormous user numbers. Apps get downloaded by millions. But if no one would pay for it, if no one would notice it was gone, then the company is not solving a real problem. It's just filling time. And filling time does not build a venture-scale business.
This brings up something that rarely appears in the glossy coverage of startup fundraising: the rejection. Most startups that approach venture capital firms are rejected. Not most, nearly all. The acceptance rate at top-tier firms sits below 1% of what they see. A firm might review 3,000 opportunities in a year and fund 15. The reasons for rejection are not always about the quality of the idea. Sometimes the timing is wrong. The market is too early, and investors need to see it develop for another 2 years before the check makes sense. Sometimes the founder is strong, but the co-founder dynamic looks fragile. Sometimes the firm just invested in a direct competitor 6 months ago and cannot be seen taking a position in the same space. A founder who gets rejected on Monday might get funded by a different firm on Thursday, because the second firm's portfolio has a gap that this startup fills. The evaluation is never purely objective. It is shaped by what each firm already owns, what their current fund thesis says they should be looking for, and sometimes who in the partnership is championing the deal internally. One enthusiastic partner inside a firm can override 3 skeptical ones. The internal politics of a VC firm matter enormously, and founders never see them. There is a term for what happens after a firm decides to move forward: the term sheet. It looks like a simple document listing how much money the firm will invest and at what valuation, but buried in the language are clauses that determine what happens if the company sells for less than expected, who gets paid back first, and how much control the founder retains over major decisions. Founders who do not understand these clauses have given away futures they did not realize were on the table. The mythology around venture capital suggests it is a partnership of mutual benefit, a firm and a founder building something together. And sometimes it is. The best relationships between investors and founders do look like that. But the structure underneath is not symmetrical. The investor has a portfolio, the founder has one company. When things go wrong, and things often go wrong, those two positions pull in different directions. An investor can absorb a failure. The founder cannot absorb it the same way. That asymmetry lives inside every term sheet, whether the language mentions it or not. And yet, the system keeps producing results. The companies that emerged from venture capital over the last 50 years reshaped medicine, communication, transportation, and daily life in ways that are now so embedded they feel natural. The funding mechanism, chaotic and irrational as it is, does identify something real, often early, often before the rest of the world catches on. The 20-year-old in the hoodie who walked out with $500,000 in 2004 was Mark Zuckerberg. The investors who wrote that check made more money than they had made on every other investment in their careers combined. They did not fund the website. The website, at that point, was barely functional and available in only a handful of cities. They funded the person who built it, the person who, when asked why he would not sell the company to a larger competitor for $10 million, said simply, "Because then I'd have to go start another one." The investors understood exactly what that answer meant. They had been looking for it without knowing how to ask for it. That is how venture capital works. Not the spreadsheets, not the market maps. The long, quiet bet on whether one person, in one specific moment in history, will refuse to stop.